Wishing a very good morning to all the participants of Lucknow DTRTI webinars 2021. And today, on 20th of November 2020, we are going to study non-manufacturing final accounts part 2 as part of the bookkeeping and account series. Friends, we are at illustration 2, and we can see that certain details are mentioned here. And after mentioning the details, it is being said that we have to prepare a trading account of Messrs. ABC Traders, whose details these are, for the year ended 31st March 2017. And also we have to pass the necessary closing entries in the journal of Messrs. ABC Traders. So one is that we have to prepare the trading account. So obviously these are all the entries which need to come in the trading account. And apart from that, we are also to pass the closing entries in the journal. So we have already identified that to find out the gross profit, we make the trading account. And to find out the gross profit, we reduce the cost of goods sold from the total sales. And we have also seen that in order to calculate the cost of goods sold, we have to add to the opening inventory the purchases, the carriage inwards, and the wages, the direct expenses, and of course the return inwards, and then we have to reduce from that the closing inventory. And once we reduce the closing inventory, we get the cost of the goods sold. So what we have to do is that we have to add all the items which come on the debit side and reduce certain items from the credit side. So we take the opening inventory. To the opening inventory, we'll be adding the purchases, and then we'll be adding the carriage inwards. We'll also be adding the wages, the direct expenses, and as you know, the return inwards are the sales returns. So we'll add the sales returns and then reduce the return outwards and the closing inventory. And having done that, we'll get the cost of the goods sold, and then we will reduce the cost of goods sold from the sales. And once we do that, we get the gross profit. So as you can see in the trading account, when we prepare the trading account to prepare the gross profit, there are certain entries we put on the credit side and certain entries we put on the debit side. And we put the sales on the credit side, and from the sales we will reduce the sales returns. Sales return is the same as the return inward, so we'll reduce the sales returns while taking the cost of goods sold. We add the return inward to the opening inventory, etc. So we reduce the sales returns and we put the closing inventory on the credit side, and opening inventory is on the debit side, purchases is on the debit side. From the purchases, we reduce the purchase returns, and we add the carriage inwards to the debit side, because these are the expenses paid for transportation, etc., to bring the goods in. And then we add the wages, which are the wages paid to the laborers who help out in the loading, unloading of the goods when they come in. And finally, the difference between the credit side and the debit side. If the credit side is more, then it is a profit, and if the debit side is more, then it is a gross loss. So here we have a gross profit of 4,20,000 rupees. It's a credit balance that is being put on the debit side, and this gross profit will move to the profit and loss account. Now let us see the journal entries. These are the closing journal entries. So how these closing journal entries are being made? As we have seen that from the purchase, the return outward have to be reduced. So for that, if we are not reducing here, we straight away reduce it in the purchase account itself. In that case, straight away the balance of the purchase account can be taken to the trading account. So as you are seeing here, the purchase account is being credited. Normally, when we make a purchase, we debit the purchase account. It is being credited because purchase has been returned back. So it's a reversal entry of the purchase, and we credit the purchase account and debit the return outward account, because when we do a purchase return, at that time we credit the return outward account. So we close the return outward account by debiting it and shifting the return outward to purchase account by crediting the purchase account here. Thereafter, we have to make the entry for the sale return. So sale return is also a reversal of the sale. So here the sale account is debited by 1 lakh rupees, and return inward account, which was originally debited when the sale return was made, it is now credited to square it off and shift the sale return to the sales account. Finally, the sale account is being shifted to the trading account by debiting the sale account and crediting the trading account. So that is how the sale account has now come into the trading account when we make this journal entry, where we debit the sale and credit the trading account. Now then, after moving the sale to the trading account, we need to move the opening inventory, purchases, wages, and the carriage inwards also to the trading account. And these entries will be debited in the trading account. So trading account debit and all these accounts are credited to square them off. And finally, and then next we transfer the closing inventory also to the trading account by debiting the closing inventory account and crediting the trading account, because this closing inventory will move to the credit side of the trading account. And finally, whatever gross profit that we are getting here, that is being moved to the gross profit account by debiting the trading account. As you are seeing that here, the trading account has been debited by 4,20,000 by the amount of the gross profit, which is a balance of the credit and the debit side. And later on, this gross profit finally will be moved to the profit and loss account by debiting the gross profit account and crediting the profit and loss account. So in the profit and loss account, this gross profit will be carried down or carried forward so that the indirect expenses can be reduced from the gross profit. While calculating the gross profit, we have reduced the direct expenses which have been incurred for bringing the goods to the condition and the location, or for making the sale of the goods to load the goods onto the trucks and other things. So all the direct expenditures related to the trading activity are debited in the profit in the trading account, and all the indirect expenses are debited or rather reduced from the gross profit in the profit and loss account. So the profit and loss account starts with the gross profit on the credit side, and if there was a gross loss, then that will be written on the debit side, and then we debit all the expenses and the losses which were not so far entered in the trading account, and we'll be writing them all on the debit side of the profit and loss account. On the other hand, the income and the gains, which are other than the sales, will now be written on the credit side of the profit and loss account. Now, we have to be careful that we have to only debit the expenses in the profit and loss account, and every amount of money that is spent, that is not to be debited in the profit and loss account, because there may be certain expenditures which may be made to buy an asset. So those expenditures which are spent to buy an asset, or expenditures which are personal in nature, not related to the business, they will not be charged to the profit and loss account. So only the revenue expenditures and the business expenditures will be charged to the profit and loss account, which relate to the current year only. Now, the current thinking is that we have to allow the reader to form a correct idea about the profit earned or the loss suffered during the period, together with the significant factors. So therefore, if we are writing too many details in the profit and loss account, and that will prevent a person from knowing properly the factors which are leading to the profit. Therefore, what is done is that we divide the items or categorize the items of expenditure in various categories in the profit and loss account, like administrative expenditure, selling expenditure, and finance expenditure. So this categorization is made to significantly indicate to the reader as to what kind of broad heads, broad categories under which the expenditure is being made and debited. So as you are seeing here, the gross profit will be brought forward or brought down to the credit side, and the gross loss will be brought down to the debit side in the profit and loss account. And as you can see here, the management expenses or the administrative expenses, the maintenance expenses, the selling and the distribution expenses, the financial expenses, and the abnormal losses. These are broadly the categories under which the expenses are categorized. In order to understand significantly what are the broad categories under which those expenditures have been made. So this table is very revealing, where we can see easily what are the nature of the administrative or the management expenses. And of course, we all know the maintenance expenses spent on the maintenance, repair, renewal, and the depreciation also. Selling expenses relate to advertisement, the rent of the godown, the salaries of the staff, selling staff, and the carriage outward in certain cases, bad debts, provision for bad debts, selling commission, and some financial expenses also, like bank charges, interest on loans, the discount that is paid, that is given to on bills, bills of exchange, and discounts allowed to the customers, etc. Abnormal losses are certain losses in the sale of machinery when we make a certain sale or sale of investment, or loss by fire. something which you are not expecting, and that was abnormal. Apart from that, whatever incomes are being received and whatever gains are being received, that are to be credited to the profit and loss account, including the abnormal gains. So therefore, what we can do is that we categorize the expenses, and after categorizing the expenses, we can make a small profit and loss account with the amounts total in the categories. And of course, if it is an electronic account, that can always be opened up with a plus sign, but otherwise a schedule can be attached by which the description of all the expenses under various categories can be given, especially where items of expenditures are very large in number. It is advisable and preferable that we categorize the expenditure as above. Now let us try and understand some other items like drawings. Now, drawings are, they are not expenses of the business. That is the money being taken out from the business by the proprietor. So it is a reduction of proprietor's capital, and therefore drawings should never be debited to the profit and loss account. It is a personal expenditure being made out of the business income, business cash. Rather, it should be debited to the capital account of the proprietor. So whenever some drawings are made, what we do is that we debit the capital account and we credit the drawings account. And before this, we make the entry like credit the bank account and debit the drawings account, because if we issue a check to ourselves, or we issue a personal check, or if it is from the cash, then we make the entry credit cash and debit the drawings. And once the drawings have been debited, then we credit the drawings and debit the capital account to transfer the drawings to the capital account. If the proprietor has enjoyed any benefit personally from the business, it could be the use of firm's car, it could be even for the use of the firm's car, a suitable amount could be treated as the drawing. And to that extent, the charge to the profit and loss account will get reduced, because a certain amount of expenditure is being treated as a drawing. So something which is drawing is not a business expenditure. That we have to be very careful about that. Then, as far as payment of income tax is concerned, income tax payable is like any other expenditure in case of companies. But in case of sole proprietorship, the income tax is not treated as a business expenditure, it is treated as a personal expenditure of the proprietor. Because the proprietor may be having different number of businesses, and for every business for every business accounts may be drawn separately. Now the tax will be paid by the proprietor, not separately on every business, but rather in a consolidated way. So some businesses may be going in loss, some businesses may be in profit, so everything will get squared off and netted. And thereafter, the proprietor will pay his income tax. So in the case of proprietor, it is considered that the proprietor's income tax is his own expenditure. Is his own personal expenditure, and so it is treated as The income tax paid by the proprietor is treated as his own personal expenditure and it will be debited to the capital account if it is paid from the business, and it will not be debited to the profit and loss account in case of a proprietor's business. So as we can see here, the initial entry when the payment is made, it will be bank account credit and income tax account debit. And thereafter, we transfer this entry to the capital account of the proprietor by crediting the income tax account and debiting the capital account. Now, the next thing that we have to understand is discount received and discount allowed. So, discount can be of two types: trade discount and the cash discount. Trade discount is allowed when the order for goods is not below a certain figure. I mean, if somebody is ordering a minimum amount of goods, then he gets that discount, and it is just deducted. This discount is deducted in the invoice itself, and after deducting from in the invoice itself, only the net amount of the invoice will be entered in the books, and this the trade discount will not be entered in the books. It will be in the invoice. But on the other hand, the cash discount is allowed to customer if he makes the payment, because there was a credit sale and the customer has to be encouraged to make the payment earlier. Then the cash discount will be offered to him if he makes the payment before a certain date. So in that case, it is an allowance being made for prompt payment, and therefore this amount is going to be recorded in the books of accounts. Therefore, the trade discount will not be debited to profit and loss account, but cash discount will be debited to the profit and loss account. Now, on the other hand, discount received is like interest received, and discount allowed is really like interest paid. So, discount which is received is a gain for the business and will be credited to the profit and loss account, and whatever discount is allowed is going to be debited to the profit and loss account, subject to, of course, what has been explained earlier, that the trade discount is not debited in the books of accounts, and it is reduced from the invoice itself, whereas cash discount is entered in the books of accounts because that is offered to make a payment before a certain date. Now, the next is the rebate. A rebate is the allowance given to any customer when he makes any purchase during a period, say 1 year, up to a certain figure. So we tell the customer, okay, in this year, if you make so much total purchase, we'll give you this much rebate. Now let's say the firm allows a rebate of 4% to those customers who purchase at least 5,000 rupees worth of goods in the year. And one customer purchases are 4,500. So he will not get that rebate. But another customer whose purchases are 5,100, he will get a rebate of 4%, which is coming to 204 out of 5,100. Now the entry for rebate will be made only at the end of the year and will not be made during the year, because obviously we are still waiting if the purchase goes up beyond the minimum figure that has been quoted for the rebate. And finally, at the end of the year, the rebate account will be debited, and later on it will be shifted to the profit and loss account on the debit side by crediting the rebate account and debiting the profit and loss account. So initially, when we allow the rebate to any customer, that time we debit the rebate account and credit that customer's account, and finally at the end of the year we credit this rebate account and debit the profit and loss account. Now let's understand what is bad debts. If the customer does not pay the amount which is due from him, and of course all the hopes of recovering the amount are also lost. So at that time it is said to be a bad debt. Bad debt is a loss to the firm, and therefore we open a bad debt account, and if there is a loss like this, we debit the bad debt account, and later on we shift this bad debt to the profit and loss account. So at the time of debiting the bad debt account, we credit the customer who was supposed to pay us, and now since we have lost hope, we are not expecting him to pay that amount, so we credit his account and we debit the bad debt account. And finally, whatever is there in the bad debt account at the end of the year, that will be transferred to the profit and loss account by crediting the bad debt account and debiting the profit and loss account, because all the expenditures must be transferred to the profit and loss account in order to be able to generate the correct amount of the net profit that is incurred. Now, in case we have to make a provision for bad debt, I mean, the debt has not actually turned bad, but we need to be very careful that we do not overstate our profits. So what we do is that we make a provision for the expected bad debts. So in case a provision has already been prepared for the bad debts, then what we need to do is that we need to write off the bad debts from this provision. We don't need to write off these bad debts in the profit and loss account in that case, because while making the provision at some point of time, we have already debited the profit and loss account to create the provision. Because what we do is, while creating the provision, we debit the profit and loss account and credit the provision for bad debt account, and thereby we create the provision. But and since once we have the provision, we need to adjust the bad debts when they happen against the provision, so that we don't debit our profit and loss account two times. Now, supposing we treat some amount as the bad debts, and the bad debts get recovered later on. So when the bad debts get recovered later on, we debit the bad debts recovered account. That we make a new account, and we debit the, rather we first of all, what the entry we will make here is that we will debit the customer and credit the bad debts recovered account, because this is the bad debts recovered by us, and therefore thereafter we'll debit the bad debts recovered account and credit the profit and loss account. So while doing that, we are transferring the bad debts recovered account to the profit and loss account, by crediting the profit and loss account, and therefore we have now profit and loss account in respect of the bad debts which are recovered, and the bad debts recovered account stands adjusted. Now let us see what are the entries that have to be made in the journal for preparing trading and profit and loss account. Now, as we are seeing, the trading and profit and loss account are to be prepared at the end of the year, and they will be prepared on the basis of the ledger. So first of all, from the ledger we prepare the trial balance, and when we prepare the trial balance, we find that the total of the debit side, the credit side, the trial balance is agreeing. And after having ascertained that we are not able to find any other difference in any other anomaly or any other error in the accounts, and we are sure that now we have a good trial balance with us. Though still some entries may be there which may be wrong, and they are we are not able to find them at that particular stage of preparing the trial balance. Maybe we'll find them later on, and then when we find them, we'll make the suitable entry. But at the particular time, we are making the closing entries here, and for making the closing entries, for preparing the trading and profit and loss account, we have to transfer the accounts to the profit and loss account and the trading account from the ledger, having already prepared our trial balance. So these entries are called closing entries. Now, we have already seen earlier that we are transferring certain entries to the trading and profit and loss account. And after having transferred all the expenditures which are related to the trading account and which are related to profit and loss account, and after having transferred all the incomes and receipts, the opening inventory and the closing inventory, having done each and every of these things, now what we have to do is that to complete the profit and loss account, we make 3 entries. We have already seen the trading account entries already. So we take up the expenditures of the profit and loss account, and we find out in which accounts those expenditures have been debited, like salary account, rent account, interest account, other expenditures. We credit all those expenditures and debit the profit and loss account with it in order to transfer the indirect expenditure to the profit and loss account. Similarly, with the items which are the items of gain will be credited to the profit and loss account, and therefore, like discount received and bad debts recovered, need to be transferred to the credit side of the profit and loss account by debiting discount received, debiting bad debts recovered, and crediting the profit and loss account. And now, finally, in the profit and loss account, we'll find the balance, and the balance will be either a net profit or a net loss. And then we transfer this net profit or loss to the capital account. So if it is profit, then we debit the profit and loss account and credit the capital account. If it, of course, is a loss, then we credit the profit and loss account and debit the capital account with it. Now let us see an illustration. Illustration 3. Revenue, expense, and gross profit balances are being given here. And we are supposed to make the profit and loss account and also show the closing entries. First of all, we already have the gross profit with us. We start with the gross profit. To make the profit and loss account, we always start with the gross profit. So as you can see here, we've started with the gross profit, and then we'll go on writing the entries of the indirect expenditure on the debit side, like salary, legal charges, consultancy fees. As we already discussed, we'll categorize them also. But for convenience sake, here it is being shown without categorization. The bad debts will also be debited here, and whatever interest is being paid for any reason, that will also be debited here. After making all these entries, the difference has been taken, and of course the discount received is entered on the credit side. We already seen the entries which are supposed to be put on income and gain entries on the credit side, the expenditure and loss entries of the revenue type on the debit side, and then we are taking the difference. After taking the difference, we get a figure of net profit of 43,000 rupees. Then we are seeing the journal entries, and as you can see, for making the journal entries, all the expenditures which have been debited to the debit side of the profit and loss account, all those expenditure accounts are being credited here, and profit and loss account is being debited. To show these entries in the profit and loss account, these are transfer of the balances found in these accounts in the ledger, which are being transferred to the profit and loss account. Similarly, discount received account would be debited, and profit and loss account would be credited, because this is a gain or an income, and we also have transferred the gross profit which we derived in the trading account, so to the profit and loss account by crediting the profit and loss account and debiting the gross profit account. And finally, whatever profit that we get in the profit and loss account, we transfer that to the net profit account. And then finally, we derive the net profit, and then we transfer the net profit to the capital account by debiting net profit and crediting capital. Now let us see that what adjustments will be required to be made in the once we have transferred the expenditures and the incomes into the profit and loss account and the trading account. And in relation to the adjustments, we have to understand the fundamental principle of accounting that is being used. And that fundamental principle is that the period to which various items of income and expenditure are pertaining that should be coextensive with the period of the, which means that only those items of income and expenditure which relate to that period of account should only be entered in the books of accounts. So before we finally drop the final accounts, we have to ensure that those accounts which require adjustment on this consideration means on the ground that whether that expenditure relates to that period only or not. And in case we have to adjust those accounts by providing some expenditure which was maybe accrued for that period and it is not being entered, and by including the income which is outstanding and has not been so far brought in, but it has accrued and therefore it has to be entered in the books. And we have to exclude those expenditures, the benefit of which will extend beyond that year of account. I mean, that the expenditure, the benefit of it will not be enjoyed during the current year or during the current financial year, but rather it relates to a different period. Now, similarly, incomes received in advance will also be treated like that. They will be taken out because they have been received in advance, but they are actually not accrued. So that we must pass these adjustment entries for adjusting various accounts. So in respect of the expenditure which is accrued and accruing, we need to debit the appropriate expense account like the rent account or the interest account or the local taxes account, and we credit the expenses accrued or expenses outstanding account with that. So first entry that we make is that we debit the respective account and credit the expenses accrued in outstanding account, and then we transfer this. Of course, the transfer, that this debit will ultimately get transferred to the profit and loss account. For example, if the rent which we have paid is 50,000 for a year and outstanding rent is 14,000, then what we do is that we add this outstanding rent to the rent that we have already paid, so that the total amount of the rent becomes 64,000, and total amount of rent which will be debited to the profit and loss account will be 64,000. And however, while doing this, we'll be transferring this outstanding rent to the balance sheet also, because it is a liability that we have incurred and we are supposed to pay this liability later on, and therefore this is a liability which will go into the balance sheet also. So basically, all the expenditures which are accrued, the account related to the expenditure which have accrued will be squared off by transferring that amount as the outstanding amount to the balance sheet. Secondly, if there is any income accrued that needs to be entered into our books, for example, there may be some interest on government loans that has accrued, there may be some discounts on the bill that have accrued, there may be some professional fees that have accrued, there may be certain amounts of rents or some lease premiums that have accrued. So all these accrued amounts will have to go into the income side of the profit and loss account, and therefore all these incomes which are accruing, in respect of all these incomes, we are debiting the concerned account and crediting the appropriate income account. So once we do that, we transfer that to the profit and loss account later on by crediting the profit and loss account and debiting the appropriate income account. And this income accrued finally, which we have put in the interest accruing account or interest fees, etc., accruing account, that will be transferred to the balance sheet, because that will be an asset. So in that respect, we will credit this account, the interest fees accruing account, and debit the balance sheet. We put it in the debit side of the balance sheet, and therefore it will move to the balance sheet. Rather, this whatever balance is there in the interest fees accruing account, the debit balance, that will be straightaway entered into the balance sheet also. Of course, the appropriate income account has been credited here, and this credit is to be transferred to the profit and loss account by debiting this appropriate income account and crediting the profit and loss account with a journal entry. And so as you can see here, the profit and loss account has been credited with an accrued interest amount of 45,000, and this accrued interest is also showing in the balance sheet here, because we have transferred this accrued interest which was there in this interest fees, etc., accruing account. We have transferred this, we have written this in the balance sheet also. As you can see, the balance was created here by debiting this account, and therefore this balance needs to be reflected somewhere, and therefore this goes straight into the balance sheet. And as far as this balance in the appropriate income account is concerned, appropriate income account means that, for example, interest on government loan account or discount on bill account or professional fees accrued account or whatever, professional fees account or rent received account, premium on leases received account. So all these accounts have been credited here. And to transfer these credits to the profit and loss account, we debit these accounts and we credit the profit and loss account with that amount. That is how this accrued interest can be transferred to the profit and loss account. Now, when we say accrued, the accrued word, if you have to understand it, it is like, dust. The dust gets accrued to the skin. So the dust, when it is accruing to the skin, it has not become part of the skin itself, but it is stuck to the skin. And therefore we say that the dust is accrued to the skin. So in that sense, we have to understand accrual. Accrual signifies that a certain amount has been either expended or earned as income, and maybe the due date of the payment will fall in the next financial period, or the due date of payment will not fall in this current period, but it has accrued. So if the due date for payment occurs in the current accounting period, the term used should be outstanding because, or accrued and due. So therefore we have to make this distinction, that we have to understand something which is outstanding has not been paid, and or the same thing can be written as accrued and due also, but it is being taken into the profit and loss account because it has been incurred if it is an expense, or earned if it is an income. So when we say accrued and accruing, it signifies those items which, though they are not due for payment but pertain to the period of the account, a provision of which has been made. So if we make a provision has been made, that means that it is already reflected in the profit and loss account. Now we go to the next one, like carrying forward income received in advance. For example, sometimes this is another adjustment that we are making. Subscription is being received in case of club or fees, in case of a professional person who has subscribed to a club, or a person is subscribed to a club, so he pays the club fees, and this club fees is paid in advance. So since this club fee is paid in advance, it does not relate to the year in which it is being paid, because it is an advance payment. Therefore, we need to reduce it from the subscription, which will go into the profit and loss account. But while paying the subscription, we've already transferred to the profit and loss account, so we make an adjustment here, and we make an adjustment by debiting the appropriate income account, and because if it is a subscription received, we are, by debiting the appropriate income account, we are reducing it from that income, because it is not the income which is received for that year. So the person who has received the subscription has not received it for that year, and therefore it will be reduced from the subscription that is received for that year. And to reduce it, we are crediting the appropriate income account, and we are debiting the appropriate income account, and we are crediting the income received in advance account. And while we are crediting the income received in advance account, this credit will be shown in the balance sheet, as can be seen here. Now, sometimes we also make payments in advance, apart from subscription, because when some payments are being made in advance, at that time we'll have to we are making those payments which are not related to that particular year. And since those payments are not related to that particular year, we need to reduce them from the expenditures of this particular year. Now, since we have already made the payment, let's say we have made a payment of rent. So at the time of making the payment of rent, we have already debited the rent account and credited the bank account, and later on we have transferred this rent account to the profit and loss account also by debiting the profit and loss account and crediting the rent account. Now we make the adjustment because part of this rent has been paid in advance. It is not meant for that year. So we credit the appropriate expenses account, and when we are crediting the appropriate expenses account means that we are crediting this rent account, and when we credit this rent account, we are reducing the amount from the rent account, and we are debiting the expenses prepaid account. So this debit in the expenses prepaid account will show in the balance sheet, and to the extent we have credited the appropriate rent account, that will show as a reduction from the rent in the profit and loss account. Now let's look at something else, which is called adjustment of the inventory of materials in hand. There are some inventories of materials that are being debited to the expenditure account, and while valuing the inventory, they have been included in the inventory. So since these amount of inventories are already debited to the expenditure account or debited to the expense account, what we do is we debit the inventory of the material account and we credit the appropriate expense account. Well, what has happened is that we are transferring this expenditure to inventory by doing this, because a certain amount has been debited to appropriate expense account, let's say the stationery account or to the advertisement account or the material account. But what we are trying here is that we are transferring it to the inventory of material account because it is suitable to transfer it to the inventory of material account, because this expenditure is in the nature of the. So to make this adjustment, we are transferring out of the expenditure account and we are moving this expenditure to the inventory of material account by debiting the inventory of material account and crediting the appropriate expenditure account. Let us take an example. Let us say that the opening stock of the stationery was 15,000 rupees and we have made a direct expenses of 1,700 rupees. Now, it is also given outside the trial balance and the closing stock of the inventory is 5,000 rupees. So what we do is that we take the opening stock of 15,000 rupees. We are adding the expenses of 1,700 rupees here. Now, how we are adding these expenses of 1,700 rupees? We have to understand that we have made this expenditure here, right? And we have put that expenditure into the appropriate expenditure account. Now what we are doing is that we are crediting the appropriate expenditure account and debiting the inventory of the material account. So therefore, in a way, this expenditure to our inventory, because this expenditure relates to that inventory. So we are making adjustment of inventory of materials in hand by doing that. And if the closing stock that we have found was 5,000 rupees, we are supposed to reduce it here. Less closing stock. So here the profit and loss account has been debited with the figure of 11,700 and the stationery account has been credited to that extent. Initially, the stationery account was debited when we made this expenditure, and finally now this stationery account has been and profit and loss account. So in a way, we should understand it as if this expenditure is duly, it is being moved to the profit and loss account because we need to treat it as a stationary expenditure and we don't need to treat it as our part of our inventory. So I would like to correct myself again here that what we are doing here is that we have taken our inventory of the materials and in respect of amount, what we are trying to do is that we want to move that expenditure that we have incurred to the profit and loss account. So expenditure that has been incurred in respect of the stationery expenditure, we want to treat it as if it is a revenue expenditure. So what we do is that we take the opening stock of the stationery, we add the expenses that we have incurred on stationery, and we reduce the closing stock of the inventory that we have taken of the stationery. So what we get is the cost of the uh, stationery that is to be debited to the profit and loss account by doing this. And finally, when we add to the opening stock of stationery the the fresh expenditure that we have made on the stationery, and from that then when we reduce the closing stock of the stationery, we get the cost of the stationery that has been incurred during the year. And when we get that, we debit the profit and loss account with the amount incurred for the year of stationery which has been utilized, because stationery is something which is being used throughout the year. So at the beginning of the year, we are taking the opening stock of the stationery, which is same as the closing stock of the stationery of last year. Now, we are aware that stationery is something which we are going to debit to the profit and loss account, and we are not going to treat it as if it is our stock inventory. So therefore, we take the opening stock of the stationery, we add the expenditure incurred during the year on stationery, and at the end of the year, after using the stationery, we take the closing stock that we have and value that, and we reduce from the opening stock plus expenses the closing stock, and when we reduce that, we get the cost of the year. And then being debited to the profit and loss account, and stationery account is being credited to transfer this balance from the stationery account to the profit and loss account. This is a transfer from the stationery account to the profit and loss account, and before that, here when we take the inventory, then we debit the inventory or material account and credit the appropriate expenses account, and that is being done initially. And after having done that, by making this adjustment, this expenditure which was incurred on account of stationery has been moved to inventory of material account. And once we have moved it to inventory of material account, it will become part of the this calculation here, and therefore this adjustment entry will help us to calculate the exact amount of the cost incurred on the stationery during the year. So this closing stock is the ultimately the inventory of material stock that we are taking into consideration in this case. And expenditure incurred during the year on the stationery, we are already while and finally the closing stock that we have got of the stationery, will reflect it in the balance sheet also as part of the closing stock. And here we have made the calculation to make the adjustment of to find out the cost of the cost incurred on the stationery during the year. So 11,700 is the cost incurred on the stationery during the year, which is being debited to the profit and loss account, and 5,000 is the closing stock of the inventory that is also being reflected in the balance sheet. Now we go to the provision for bad and doubtful debts. Whenever there is a fear that some amount which is due from customers may not be collected, so on a prudent basis, we need to recognize that expected loss that we may incur, and so what we do is that we reduce the current year's profit on a prudent basis, and for doing that we debit the profit and loss account and we credit the provision for bad and doubtful debts account. And when we do this profit and loss account debit will reduce our income, and this provision credit in the provision for bad and doubtful debt account will be shown in the balance sheet. And whenever there out of our debtors, if some amount finally becomes actually bad. So normally what we do is that we debit the bad debt account and credit the customer account. But however, if we have created the provision, we will not we will credit the provision account because we have already created the provision for this. So wherever there is some test happening or examination and some question is being asked where it requires that certain bad debts should be written off and correspondingly a provision for doubtful debt has to be made, then what we do is the amount of bad debts to be written off should be first debited against the existing balance of the provision. Because if there is an existing balance of the provision, then you debit the bad debts and credit the balance of the provision. Once the balance of the provision expires and you need to debit more bad debts, then in that respect you debit the bad debts, extra bad debts that are not getting adjusted in the provision account, and credit the customer in respect of those. So to understand this treatment, let us understand it by way of an illustration. So on 1st of January 2017, there was a provision for doubtful debts of 40,000 in the balance sheet. And trade receivables at the end of the year were 15 lakh rupees. On the first day of the year, on 1st January, there was a provision of 40,000 rupees of bad debt of the doubtful debts. But at the end of the year, we were supposed to receive 15 lakh rupees and 1 lakh had already turned back. Now we were required to write off these bad debts and create a provision equal to 5% of the trade receivable balances. Now what is being said here is that we have to write off the bad debts. So as we know that if we have to write off the bad debts, then in order to write off the bad debts, we have to write off the bad debts initially against the provision that is there. And if there are still some bad debts which are not written off, then they have to be written off against the customer's balances. So what we do here is that in this case we have a bad debt of 1 lakh rupees. So we have to adjust the bad debts of 1 lakh rupees. Now we know that we have a provision at the beginning of the year. So obviously, some of the bad debts can be adjusted against this provision at the beginning of the year. But we are also seeing that it is not enough because provision is only 40,000, whereas bad debts are 1 lakh rupees. Now we are also told that we can make a provision equal to 5% of the trade receivable balances. So, and our provision should never be more than 5% of the trade receivable balances. We have to take that into consideration. Since at the end of the year, our trade receivable balances are 15 lakh rupees, and our bad debts are 1 lakh rupees. So we start with the opening provision of 40,000 rupees, And since we are supposed to write off 1 lakh rupees, we know that we have a short provision of 60,000 rupees. So our provision is short by 60,000 rupees. However, the provision that is required, which is 5% of 14 lakh, 5% of 14 lakh, because 15 lakh were the trade receivables, but bad debts were 1 lakh. So trade receivables, net trade were 15 minus 1, which means that net trade receivables are now 14 lakh rupees. So we need a provision of 70,000 rupees to be made, to be kept in our accounts, and at the end of the year. So at the end of the year, we should have a 5% of 14 lakh provision in our account. Apart from that, we need a provision of 60,000 rupees to adjust these remaining bad debts of 60,000 rupees, because 40,000 will get adjusted against the opening provision of the bad and doubtful debts. So we need to adjust 60,000 more of the bad debts against the provision. So we need a fresh provision of 60,000 for adjusting these bad debts. We also need a 70,000 provision because we need to have this 70,000 provision, which is 5% of 14 lakhs at the end of the year. So we need to, therefore, total provision of 1,30,000 rupees. So since we need this provision of 1,30,000 rupees, we will make this provision in the provision for doubtful debts account is 70,000 by as we are seeing the balancing figure here, 1,30,000 rupees. So we are crediting the provision for doubtful debts account by 1,30,000 rupees, and we are debiting the profit and loss account. So this is the provision creation entry of 1,30,000 rupees, because total provision that is required is 1,30,000 rupees. So we are ultimately we were having a balance brought down 40,000 rupees. We created a fresh provision of 1,30,000 rupees. Out of that, we use this provision to the extent of 1 lakh for the bad debts, and we are left with a provision of 70,000 rupees, which is carried down provision, and that is what we required, because 70,000 is the provision that is required at the end of the year after having adjusted the bad debts. Similarly, now we can go for provision for discount. Now this provision for discount, it is also created in the same manner as in the case of a bad debt, because this amount of provision will be required to be calculated after deducting the provision for bad debts from the total trade receivables. Because this discount is a cash discount being offered to the customers who are part of the trade receivables, and we are offering this discount so that they make us the payment as early as possible. So because we are offering this additional discount called the cash discount, we have to keep a provision for it in our books. If we don't keep a provision on a prudent basis, then we are not thinking rightly in terms of how to not overstate our profits. We need this to create this provision so that we do not overstate our profits. So we will debit the profit and loss account and credit the provision for discount account to the extent we consider necessary, that we need to offer the discount to the customers. So to calculate how much discount we need to offer to the customers, the first thing that we need to do is that we deduct the provision for bad debts from the total trade receivables, because whatever debts have already turned bad in respect of those debts, we don't need to offer any cash discount, because those debts have already turned bad. So first thing is to reduce the bad debts from the provision for bad debts from the trade receivables. Rather, we deduct the entire provision for bad debts itself, because we have created this provision on an estimated basis. We are estimating that whatever we have created the provision for, that will turn bad, and therefore we'll reduce the provision for bad debts from the trade receivables, and whatever will remain after that, on that trade receivable, will be offering a discount. So in order to calculate how much provision is required, this provision will be calculated on the figure which is arrived at after reducing the provision for bad debts from the total trade receivables. For example, if the total trade receivable is 5,20,000 and our provision for doubtful debt is 1,20,000, we will reduce this 1,20,000 from 5,20,000 and we get a figure of 4 lakh rupees. Now on that 4 lakh rupees, we'll create a provision for discount. So if we think that 10% we want to create a provision to the extent of 10%, we are estimating that we may have to give a discount of 10% to encourage the early payment from those persons who are part of the trade receivables from our debtors, who are not provisioned to be turning back. Therefore, we create the provision, and to create the provision, we debit the profit and loss account by 10% of 4 lakh, which comes to 40,000, and we credit the provision for discount account. And when we credit the provision for discount account, this provision for discount will show in the balance sheet. So instead of adding it to the liability side of the balance sheet, we reduce the provision for doubtful debts as well as the provision for discount from the debtors itself, because that is a more rational way of looking at the debtors. That out of the total debtors of 5,20,000 rupees, I think that 1,20,000 will turn bad, and therefore I've created a provision. So I'll reduce this 1,20,000, not expecting them to pay, and then I have also created a provision of 40,000 rupees. I have to give a discount to others who are going to pay. So ultimately, having created these provisions out of the debtors, I'll be left with these debtors' expected payments of 3,60,000 rupees, which I'm expecting that I will get back. Thereafter, there is a provision for depreciation. So, in respect of creating this provision for depreciation, this provision can be made in two ways. Either we debit the depreciation account and credit the provision for depreciation account, and afterwards I close the depreciation account by transferring the balance to the profit and loss account by crediting the depreciation account and debiting the profit and loss account. Or the second method of creating the provision is that I directly debit the profit and loss account and credit the provision for depreciation account, and while doing it, I can include a detailed narration in the journal, that what is the nature of this depreciation adjustment, and this amount of depreciation, because when we have debited the profit and loss account and credited the provision for depreciation account, we will show in the balance sheet by reducing the provision for depreciation from the asset. So as you can see here, from machinery actual cost 15 lakh and or WDV is 15 lakh, and from that provision for depreciation has been reduced. Thereby, we are expecting that after depreciation, this will be the value of the machine at the end of the year, 13,50,000 rupees. So with that, we come to the end of this webinar. We'll continue the webinar today in the evening again from point number 9 of the adjustment. We are doing adjustments and we'll continue with the adjustments in the next session.